Welcome once again, and to those of you who may be new to financial brokerage, this is something that we do here in assisting all of our contracted producers and those who have yet to become contracted, and hopefully you'll pick up some great ideas today to help you go back out in the field and make more money than you were able to do prior to today. We do appreciate your time and realize that you make money when you're in front of clients, so we're going to go through this quickly. You will have an opportunity to ask questions. Just type them into your screen, and of course you can always call us later on if there are some very specific questions or something that is client specific. We'd be very happy to walk you through all the possibilities that we'll discuss this morning, as well as all the others that are out there. I'm joined this morning by my counterpart on the annuity side of things here, Matt Nutzman. He is one of our annuity sales managers, and being a life insurance specialist, I am well versed in the life insurance versions of these hybrids, not so much on the annuity side. So we've enlisted Matt's expertise to help us out. Matt will also be speaking about some of the prospecting tools you can use and who you should be speaking to about these hybrid type policies. To give you a quick preview of everything we'll be covering this morning, we'll speak about why there's even a need for long-term care insurance, how hybrids fit into this, where did they come about, why should we be looking at them. I mentioned Matt will be speaking about who buys these products, and also where can you help your clients find the money. It may not always be obvious, but we'll give you some ideas there. And then we'll go into a little more specifics on the types of hybrids that are available, the annuity-based hybrids, and then also the life insurance-based hybrids. Many of you may be coming from a long-term care background, others from a life insurance or annuity sales background, but whatever your main focus of your business, I think you'll find this can add a lot to what you're doing and lead to additional sales here this morning. So the need for long-term care, we're all going to get older someday, and there's a good chance that we won't be as physically fit. We won't be as healthy as we are today, and we might need some help with our daily activities. In fact, the high cost of extended care is the greatest threat to our clients and our own assets. Should we become ill or frail as we age, you can have a downturn in the stock market, but I tell you what, the stock market turns around and goes back up. If you have a need for long-term care, that hit to your finances is going to continue. It's not going to get better. In fact, as people move along, they tend to only need more and more care, which is more and more expensive as time goes on. So there's a great need for long-term care. Solution of the past, traditional long-term care insurance. It's been around for a long time. Sales have been doing well. They've done not so well over time. We've seen premiums go up. We've seen premiums for existing policies go up over time as well. And for a lot of folks, it's become a little more difficult to sell in some situations. So traditional long-term care, it's great. It applies in some situations, but it's not necessarily going to work for everybody. So that leads us right into the hybrid policies. And there's certainly a couple reasons why people are purchasing hybrids these days, and they usually go back to two really important guarantees. One is that the premium will never change. You don't have to worry about having a rate increase down the road and dealing with that conversation. The other reason people purchase hybrids is that they know the benefit will indeed be paid out. Whether it's paid out as a long-term care benefit, or it's paid out as the death benefit or the annuity payout as well, somebody is going to receive the benefit. And clients don't have that same sort of assurance with a traditional long-term care policy. Now, what do all these linked benefit products have in common? Well, there are some key elements here. They're all filed as insurance products, whether it's life or annuity, and they all function very similarly. The benefit is accelerated for long-term care. That's one of the selling points. We know that a benefit is going to be paid out. It's just a matter of how. It's not like a homeowner's insurance or an auto insurance. If something bad happens, you get a benefit. With this, something is definitely going to happen. You have a 100% chance of the benefit being paid out. We just don't always know how that's going to happen. And the triggers for the payout are the same as a traditional long-term care policy. For all of these products, the client needs to lose the ability to perform 2 of the 6 activities of daily living, or have severe cognitive impairment. The most common one we hear about is Alzheimer's. They can't take care of themselves, and they need some additional help with that. So before we delve into the product specifics, we'd like to speak a little bit more about who should you be speaking to about these types of products. Who are the prospects, and how can you help them find the money? So with that in mind, I'm going to turn it over to my counterpart, Matt Nutzman.
Thanks, Brian. I appreciate that. Really, the key to this market is finding the prospects. We all want to find more. And really, as an agent, you want to be aware of the right people that you need to talk to, and the people that you may bump into. Really, this market, typically what we see is clients that are 50 to 75. We have a few products that go up to age 80. And these clients typically have a large sum of what I call lazy money, money sitting around in CDs, money market funds, cash value, and a life policy that they may not need anymore. But really, the bottom line, the best products in this market are the ones that say no to traditional long-term care. And it's always the same objections that we keep getting. The people are tired, they're worried about rate increases on their long-term care policy. They're worried about ongoing payments. They may be underinsured on their long-term care, but they don't want to buy another traditional long-term care policy. And they want liquidity, and they want control of their money. They want to be able to walk away, and if they don't need it, because bottom line is most people, they just truly believe that they are not going to need long-term care. And as a long-term care agent, you hear that all the time. So I'm going to get into really the specific markets and life events that you need to look out for funding. In the business market, people that would be a good prospect would be people that have a non-qualified deferred comp, also people that receive bonuses. And then what I've recently seen is I've seen sellers of businesses and farms that have a large sum of money that come to them. And this is a great opportunity to talk to them about a hybrid product, whether it's life or annuity, just to give them a little bit more value. And additional resources of finding the money, so to speak, is people have DI or life policies with a return of premium feature, permanent life policyholders who no longer need the insurance. It's where we can just simply 1035 that money into a life or an annuity product. Annuity owners currently, that have no long-term care benefit to their, to their plan. Also people with CDs coming due. It's a great opportunity to talk to them about other, products that are out there, and like the hybrid products. That may be the selling point for them to stay with you rather than move the money to another advisor. Another resource would be homeowners who are downsizing. We're seeing the baby boomers, they're downsizing, they have more money, they sold a house, they're moving into something smaller. They have a large sum of money available to them right now. And also people that, beneficiaries to get a life insurance death benefit. This is the perfect time to talk to them about their options, and, just simply look at, a hybrid type product. There's a couple types of hybrid annuities. We have a single premium deferred annuity, and then we also have, a flexible premium product as well. And, on the life side, obviously there's a single pay, multi-pay, and any pay. But getting really into the hybrid annuity, the advantages of the hybrid annuities are typically you'll have a higher benefit early in the plan. compared to maybe a life type of hybrid. It's a funding resource. Clients who already own an annuity, they can only transfer the money into another annuity. They can't do it in a life product. Also, inflation protection. Most LTC annuity products, they provide 2 to 3 times the accumulated value of money for long-term care. And most of the annuity products out there have an inflation protection endorsement of 3 to 5%. Also, underwriting. This is probably the most vital, important information you can get. With the long-term care market and its current condition, with a lot of carriers getting out, we have some big-name carriers that recently got out, Guardian, Met, Allianz. Underwriting is getting really sticky on the traditional side. And more, I'm having long-term care agents come to me to run illustrations for annuity products because they know the underwriting is less stringent, and they're going to have a better opportunity to get their client insured with long-term care. Getting into specific products, we have on the annuity side, we have a living care annuity with United of Omaha. Then we have annuity care 1 and 2 with State Life. And we have the Lincoln long-term care fixed annuity. And then what's really trending is our annuity riders on our index products. We have the Edge Plus rider with Aviva and also the protection package with F&G. Getting to my favorite product, United of Omaha, they have the living care annuity, which the key product feature to this product is you can get up to 3 times the annuity value at the time of claim in long-term care benefits. And this product really works like a traditional long-term care plan in that it covers in home health care, assisted living, nursing home care. It's a great product. And typically that pool of money will last at least 6 years, and it's earning a guaranteed rate of interest at 2 1/4. You have access to principal through partial withdrawals or lifetime income. It also has the 10% penalty-free withdrawal after the first year, and it does provide a death benefit that is equal to the annuity value at the time of claim. Another couple reasons why I really like this product is there's only 12 health questions, and there is a phone interview. And it's very liberal in underwriting compared to traditional long-term care. One thing that I have to make long-term care agents aware of is, if you have a client that's they have a good possibility of getting declined on the traditional side of the product, you may want to look at the annuity product first. And the reason I say that is if they get declined for traditional long-term care first, they have to wait 3 years to get this type of product. And I know I've had a lot of long-term care agents call me and say, well, I got a decline, and, what about this annuity product you were telling me about? Well, the bottom line is you're going to have to wait 3 years before you can reapply for the annuity. So, if there's any question in your mind that you may have a decline, this is the time to look at the United of Omaha Living Care Annuity first. State Life also has a product, Annuity Care 1 and 2. You can either issue it as a single life or joint life. It's simply just a dollar-for-dollar benefit. The LTC fund does grow at a higher percentage rate. There is no medical exams and even more liberal underwriting than compared to the United of Omaha Living Care Annuity. Really the key feature to this is you have the option to purchase a rider to extend benefits for a lifetime. Really the only difference between the two products, the 1 and 2, is the 2 has a built-in continuation of benefit rider. And the reason that I put this product on our lineup is for those agents that are in California, Florida, Texas, the United of Omaha Living Care Annuity still is not approved. So you'd want to look at the State Life product. And it is very liberal in the underwriting. And I'd be more than happy to talk to you about the current cases that you have that are out there that we can try to get through them. One of the new trending factors in the hybrid annuity market is the income riders. We have 2 products. We have the Aviva product and F&G product. Aviva has the Income Edge Plus rider, And simply, this rider will just double your income payment if you're confined to a nursing home. There is no underwriting. And we're seeing a lot of business written, especially right now with interest rates that are down, caps are down, participation rates are down. They're simply at their all-time lows. And, you know, by bringing up this rider with the income double feature, it may help you get a sale that you never had before, or you wouldn't get before. So there's a couple, you know, key factors in the eligibility of getting this double income payment. Basically, you can't be confined at the data issue. You must be confined to qualified care facility for at least 180 of the last 250 days, and benefits must begin in year 2, and it has to be a written recommendation of a licensed physician. But once again, there is no underwriting to this at all, and it will help you get that sale that you may have missed before. Fidelity and Guarantees protection package that you can add to their index lineup is a little bit more comprehensive in the fact that it will pay for home health care, assisted living, and nursing home care. And it does, like the Viva product, double your income payment. There is no underwriting, once again, and you know, there are a couple key factors there in eligibility. You must have the product in force for at least 5 years, and no additional premium payments must be made in the last 3 years. And the annuitant is 60 years and older and must meet 2 of the 6 ADLs. So great feature, no underwriting, and once again, you know, it'll help you get that sale that you could have missed. So I'm going to turn this over to Brian here to discuss the life products a little bit more in detail. Here you go, Brian.
All right, yeah, thank you very much, Matt. And I'm going to review the life-based long-term care hybrids that are available out there. And I've arranged them in sort of my own fashion here. I don't know of a single carrier that arranges them this way, but it helps me keep them straight. Hopefully it will help you keep them straight as well. I found a lot of producers who are somewhat familiar with hybrids know of one type of hybrid, and that's it. They don't know about the others. Maybe they know about the annuities, but not the life. They know about the single premium only type hybrids, but they don't know that a client actually has an option with another carrier to pay an annual premium or even a monthly prearranged checking withdrawal kind of premium that looks and feels just like a regular life insurance policy. They don't all have to have a large lump sum of money sitting around to purchase one of these types of hybrids. So I want to kind of clear that up for everybody here and give you an overview of exactly what's available out there in the marketplace. So we'll start with single pay. We'll go over the multi-pay only type products, and then what I like to call the any pay, where it's a product that could be arranged as a single premium, a pay till age 120, maybe it's the 20 pay, but it's up to you and the client how you want to arrange that. So starting off with the single pay type products, these are probably the oldest ones that are on the market as far as they've been around for the longest period of time. A lot of folks are familiar with the MoneyGuard through Lincoln Financial. Total living coverage from Genworth. When they started that, they hired a bunch of folks from MoneyGuard to create a very similar product. But they do look very much alike. They require a single premium from the client, and that single premium goes into a universal life. Now, this isn't one of those that has a no-lapse guarantee. This is a current assumption UL, but it's also a modified endowment contract. These things are cash-rich like you wouldn't believe. I suppose there's a possibility the thing could lapse, but I don't know what would have to happen, something far worse than the recession that we've all just experienced right now. So a great way for a person to move some money around from the left pocket to the right pocket so it can be used as leverage to give them the care that they're very likely to need down the road. They may have money already sitting around in a fund. Maybe it's in a CD. Maybe it's just in their savings account. You ask them, what's the purpose of this money? Well, that's our emergency money. And then you ask them, why do you need a $200,000 fund for an emergency? You know, do you have homeowners insurance? Do you have auto insurance? Do you have liability coverage? Do you have Medicare or health insurance? There aren't many emergencies that will cost that much that they haven't already insured. So what are you using that money for? Let's take maybe a portion of that. We'll use it as leverage. Maybe 50 grand buys you the 200,000 of coverage for long-term care. That's an oversimplification, but you can run the illustrations and see what that would give a person. Now you've just freed up tens of thousands of dollars for that person, and you're going to be their favorite insurance agent from here on out. But both of these, getting back to these products, they both work similarly in that the long-term care benefit is paid out as a percentage, a monthly percentage of your original benefit. When the person goes unclaimed, they'll get, depending on the product, 2, 3, maybe 4% of that available for LTC per month. So that's for the folks that have this lump sum set aside and want to put it into these modified endowment type of contracts. Now, the other way to handle a single pay is the way State Life does it. Now, State Life, many of you may be familiar with the Asset Care product. It was, I think, originally launched by Golden Rule. I remember getting invited to seminars they were hosting in various places around the country as far back as about 10 years ago. So this has been around for a while. State Life took it over a few years ago, and they've actually expanded upon it. So their single pay whole life, this does have an ironclad guarantee since it's on a whole life chassis, and they have 3 versions of this, the 1, the 2, and the 3. And like the previous 2, the long-term care is paid out as a monthly benefit. It's a percentage of your original benefit amount. Now, the long-term care could be just simply an acceleration of your death benefit. A $200,000 death benefit can be accelerated, and that's your pool for long-term care as well as your death benefit. They do give you the option, though, if your original pool has been exhausted, you could purchase an additional income stream, or I should say a long-term care coverage stream for an additional 25 months. So now the client has an additional 2 years if they've exhausted their original pool. They also have the ability to purchase a lifetime benefit on this. So you exhaust your original pool of money. Now you have a lifetime benefit. As long as you live and need care, that's going to continue to pay out to you. So you can get lifetime coverage with this. And I give you the breakdown of the 3 different types here on the single pay chassis. Why do they have the 1, 2, and the 3? Well, the 1 is meant for money that's coming from maybe a person's bank account, maybe a CD. They're going to be writing a check for this Asset Care 1. And that's very similar to the Money Guard and the TLC from Genworth. The money is coming from just their regular accounts. Now, the 2 and the 3 work a little bit differently. They actually combine in an annuity product. The 2 is meant for non-qualified annuities, and the 3 is meant for qualified money. This could come from an annuity. It could come from an IRA. It could come from a person's 401k. And there's a great prospecting opportunity out there for you. If you've got clients who don't have that lump sum set aside in their bank, guess what? They probably have a 401k. And it doesn't take it won't hurt them much at all to take a small percentage of that and move it into one of the Asset Care products. Now you've just protected the rest of that 401k that they need to live on in their retirement years. A little more of the inner workings of the 2 and the 3. The money comes from its source, whether it's non-qualified or qualified, and transfers by a direct transfer into one of State Life's annuities. So at this stage, we have no taxation at all. We're just moving from one vehicle to another. And then what State Life will do, which I think is just really innovative, they will essentially bleed off that annuity over 20 years, and it goes into their 20-pay whole life. So any gain you have in that fund, in the non-qualified, or of course the qualified, it's all taxable once you take it. That's going to be split out over the course of 20 years, so you don't have to take that tax hit all at once. So it goes into the 20-pay whole life. The whole life gives you an immediate death benefit and, of course, an immediate long-term care benefit as well. And if the money's coming from a 401k, you haven't taken anything out of their pocket. So it's just fantastic the way that they've arranged this. But the asset care does have a 4% guaranteed interest rate. It's really hard to find 4% guaranteed interest anywhere. And they do give the client the ability to walk away with their principal, not principal plus interest, but just the principal at any time. So they do have what I like to call the chicken exit. Now, next category, I would call this the multi-pay. State Life has this Asset Care 4. It's a whole life, and they do not allow a lump sum into this particular product. It is meant to be paid annually or monthly, however the client is used to paying for their life insurance premiums or their long-term care premiums. They have a 10-pay version and a 20-pay version if they would like to have that paid up in a shorter period of time. But it works the same as the other asset cares. Just the method of payment is a little different. And this is going to be maybe a different type of individual that's going to be able to pay each month or again annually. And then the last category, this is my own, I guess, naming of it here. I call this AnyPay. And all of these carriers here utilize a no-lapse guarantee universal life. So they have a guarantee that the premium will never change as long as they pay the premiums every time on time. They make no loans, no withdrawals. The policy is going to remain in force as long as you had illustrated it for on the illustration software. Now, all of these work a little bit differently, and I'll go over that briefly. One thing they do have in common, though, is that there is no extra pool of money. The death benefit is your long-term care benefit on these, and that's what you've got. Underwriting on all of these linked benefit life products tends to be a little easier than a traditional long-term care. Most of these riders you see here are issued up through a Table 4 rate class, and that's provided the client is, in many cases, no older than age 75 at the time of application. So you may have a client with a condition that is debilitating, might prevent them from receiving a long-term care policy. But from a life insurance perspective, they're not worse than a Table 4. Maybe they're a standard rate class, and they can certainly, in many cases, get one of these policies here. So brief recap of how each one of these work. North American, I abbreviated what they call the Chronic Illness Accelerated Benefit Rider, and to me this seems like the simplest payout. They allow the client to receive up to 24% of their initial death benefit per year for long-term care purposes. The amount that they receive is going to be based on a what looks to me to be a kind of a complicated calculation based on the client's life expectancy and current interest rates. But they can receive up to 24% per year for the cost of care. Now, Protective Life has the Extend Care rider. With this one, the client chooses a monthly dollar amount up front. It could be up to $8,500. But whatever you put on the application, that's the maximum the client is going to have available per month for the cost of care should they qualify for the benefit. The more you request, the higher the cost of the rider. So if you request to have the full $8,500 available, it's going to cost you more than if you said, I just want $5,000 available per month. Back up one here, North American, that rider that they offer, that's available on all of their universal life. It's built in. You don't have to add that extra. It's already in the product in the states where it's approved. Moving on, AXA has what they call the Long-Term Care Services rider. This also costs extra to the client, and they can choose to have 1%, 2%, or 3% of their initial benefit accelerated per month for the cost of care. And Mutual of Omaha or United of Omaha is the underwriter. They have what they call the Chronic Illness rider, and they allow the client to request just about whatever amount that they want for this, for the cost of care. They do have a cap of $250,000, and the amount that they'll actually give out to the client, again, is based on life expectancy and current interest rates. But they can request a very high amount there with Mutual of Omaha, as long as they have not already exhausted their full death benefit. And the one that's really different from all these others here is American National with their Living Benefits rider. And again, this needs to be added to the policy. But if the client wants to exercise this benefit, it works a lot like a life settlement, where people will sell their life insurance policy to a third party in return for cash. The cash is an amount that's less than the full death benefit. Well, American National, to me, it seems like they found a way to bypass that third party, because should you qualify for benefits, you have to tell them I'd like to exercise my benefit here, and they will underwrite at that point in time. They'll look at your life expectancy and current interest rates, and the worse your life expectancy looks, the more of that benefit you're going to receive, and you'll receive that as a lump sum. So maybe you start off with a $500,000 policy. They look at your life expectancy and they say, well, we'll pay you $200,000 right now, and then that's the end of your policy. The policy goes away once you receive that cash. So again, that's a little different take on how these work. So give a quick recap of all the life insurance-based hybrids out here. We've got the UL, the modified endowment contract types with the MoneyGuard and the TLC. State Life puts everything on a whole life chassis and really has some innovative ways to help your clients locate the funds for that. And then the last 5 I just covered, and they're all on a no lapse guarantee universal life chassis. And we're just about to the end here, and we do have several questions that have been popping up, and I tell you what, Matt and I are going to see if we can answer as many of those as possible. But we'd like to start to the conclusion here. Bottom line is your clients need protection. We've all seen the statistics that 1 in 2 people are going to need some form of extended care in their lifetime. We don't know if we're the 1 or the 2 or maybe both of them. So you need to make sure everybody is covered. A lot of people don't like the previous solution to this, the traditional long-term care policy. It's not for everybody. It's great if people have that coverage, and I don't want to stop anybody from selling it who is selling it and having success. More people need to have traditional long-term care, but it just doesn't work for everybody. There's no one-size-fits-all. So the hybrids give you another tool you can use to offer protection in any form that your clients really prefer, and they come in 2 flavors, basically, the annuity-based long-term care and then the life insurance-based hybrid type of products. And as we're sort of compiling our answers to the questions here, I also want to put in a little plug here. If there are any other producers out there that you know of that should have attended this webinar or would have benefited from this information, maybe they're long-term care specialists, annuity specialists, maybe it's a registered rep who deals with people's investments, or it's a life insurance specialist, be sure and tell them about us here at Financial Brokerage. Have them ask for Brian or Matt, and we'd be happy to walk them through this presentation at any time and give them a personalized version and answer the questions that they might have there. So at this point in time, we're going to go through the questions here, and we'll get to as many as we can here. And I think I'm going to see if Matt can answer some of these that are more applicable to the annuities here to start with.
Thanks, Brian. First question here in regards to the annuities would be from David. His question is regarding the 3-year decline rule. Does that apply only to the United of Omaha product? It does apply only to the United of Omaha product, so you'd want to look at the the State Life Annuity Care 1 or 2, or one of the riders you can add to an index product. So hopefully I answered that well enough. You want to take the next one, Brian?
Yeah, we have a question here from David asking, can you 1035 from a life insurance policy into asset care? Well, if a person is going to do that, it would be the Asset Care 1. I can double check into the product guide and see not every carrier accepts 1035 exchanges, even though they're allowed by law. So, but the Asset Care 1 would be the product that would be available for that. I'm going to take the next one it's right here as well from Lynn. Are any of the NEPAs available in California? And unfortunately, last time I checked, those riders are not available in California. For some reason, there's a difficult time making them available. I do know that the state life asset care products are something that we have available in California for sure. And then we had another question here from Pete involving a person who is already receiving care. I know that the life insurance-based products will not work at all. If someone has already lost those ADLs, they're not going to be underwritten for that. I don't know, Matt, are there any of the annuity products that would work in that situation?
Brian, unfortunately, there's really not much you can do there. There's typically a waiting period, or you can't already be receiving care. So yeah, just really not a good fit, other than maybe some type of Medicaid planning, using a Medicaid type SPIA. So, Brian, I'll turn it over to you.
All right, thank you, Matt. And that looks, oh, you know what? I'm seeing a whole bunch more questions pop up here now, so that were not there previously. So we'll see here. We do have a question here regarding partnerships, and I know that none of these linked benefit products are available as a partnership type of product. They're not eligible for the protection that those partnership plans offer. So if you want to go that route with the client, the traditional LTC with the partnership would be the way to go. Matt, you want to handle the one from Harry here?
Okay, sure. The question here is, how do the products pay in relation to the annuity? Do they use their money first before the LTC rider kicks in? With these products, once the client can't perform to the 6 ADLs, or is in a nursing home, they have an event, then that, depending on the product, most of the products on the annuity side create a pool of money for long-term care. So, but you'd want to call me and go through each specific product in detail on that. Okay, Brian?
Yeah, we have a question from Lillian here, the difference between the Asset Care 2 and 3. The Asset Care 2 is designed for non-qualified funds, and the Asset Care 3 is designed to accept qualified funds like qualified IRAs. And we also have another question here on critical illness riders. Do they cover long-term care benefits? I am aware of some carriers out there that combine critical illness with long-term care. In fact, the American National product, the way they underwrite that, it's all going to depend on what the client's problem is. If it's a need for long-term care, or if they've come down with some sort of critical illness without the actual need for long-term care, they can accelerate that. But if you need a Band-Aid on your finger, you're not going to get very much. If you have 2 months to live, you're going to be able to get to a lot more of that money. Minimum age for the Asset Care through State Life is another question here from Susan. And I think they start that out about age 50, if I remember correctly. And then we have a question here from Chris on starting out, seeking long-term care clients. Where could I begin? Matt, I'll let you handle that.
Great question, Chris. We have a leads on demand system on our website that you can actually access, and I'd be happy to review that with you and show you how to generate your own leads, which are always the best leads. And we also have some other vendors where you can either do direct mail or some type of wave marketing. But I'd be able to review all those prospecting methods and lead systems for you. But yeah, great question. That's really an in-depth question that we could talk about for hours, but I'll definitely give you a call on that. Or if you're wanting more information, feel free to give me a call today at the office. Brian, you want the next one?
Yeah, let's see here. Yeah, we've got some Asset Care questions showing up here. Do the Asset Care 2 and 3 include leveraged long-term care riders with no additional premium? Well, the premium is all paid up front with those, and so if you need the the extension rider for the extra 25 months or the lifetime benefit, that will cost the client a little bit more upfront, and it's all included up there with that amount. And of course, the longer the benefit period goes, the smaller the benefit amount per month is going to be for the money that goes in. So you can only slice up that dollar so many ways. If you want to stretch it longer, you're not going to have as much available to you to start with there. And we do have a question here about the approval in a particular state. I don't have that at my fingertips. I don't have access to my computer at this point in time to check that. If you want to give us a call, we can certainly look that up for you there. So, and I think we're probably about ready to wrap this up. If there were some questions that have remained unanswered, feel free to give us a call here at 800-397-9999. My extension here is 3371. That's for Brian, and Matt.
Mine's 3124.
Right. I'd like to thank you all once again for attending this morning. We do really appreciate your time over here, and we know it's valuable. The next scheduled financial brokerage sales building webinar will be next Wednesday. That's February the 8th. It's titled Boost Middle Market Sales with Cutting Edge Technology. That will be hosted by Sarah Stewart. She is our Vice President of Administration here at Financial Brokerage. She'll be co-hosting with Jeff Waddington of Genworth Life. If you've not received your invitation already, please contact one of us here at Financial Brokerage, and we'll be happy to get that out to you. Hope you all have a very productive day, and thank you once again for attending this morning.